Hey everybody, welcome to Sector Spotlight. I'm Alec Richards, I'm an analyst on the energy team, and we're going to talk everything energy today. I'm joined here today by Kevin Kaiser, the man who signs my checks and is also our, our energy sector head. Today, since Amazon Cloud decided to go down, we're having some issues with our Q&A chat, and not only that, but it's destroying half of the people in this office workflow. So if you have any questions that we can address live here, you can email them to QA, that's the two letters, Q&A at hedgeye.com. And with that, I will turn it over to the guy in the spiffy blue suit, Kevin Kaiser.
Thanks, Alec. Appreciate that. Yeah, so welcome to the Sector Spotlight, the energy sector. And what we're going to do today is just walk through one of our recent ideas, just to give everybody sort of an idea of the work we do and the process and the work that goes into it. We're going to talk about SemGroup Corp. It's a midstream C Corp with assets in different plays in the US and also some international assets as well. So we're just going to walk through some of the key points of the thesis, talk about some different charts that I think are important, and then some updates on the thesis since we came out with the call in October. So with that, we'll get right into the slide deck, starting on the thesis summary slide. So the first point here is, I really think that these assets are poorly positioned. You think about the most profitable plays, particularly oil plays in the country today. It's clearly the Permian in the SCOOP stack, and really SemGroup has very little exposure to those plays. So we look at this company and I think it's a hodgepodge collection of assets. It doesn't really have much scale or really a footprint that's really needed in today's midstream environment to have that competitive advantage. And like I said, no exposure to the Permian, no exposure to the SCOOP, well, minimal exposure to the SCOOP stack, which it's having to invest in picking up a little bit of exposure there. And then in the gas plays, no exposure to the Marcellus or the Utica as well. The second point is just that we think profitable growth will be difficult for this company. The midstream sector is coming off a major boom. Organic growth has slowed. What we really need to have the success in today's midstream environment is a large integrated footprint. SemGroup doesn't have that. We consider SemGroup to be a market share donor. With limited scale or competitive advantage, we believe that SemGroup will have a tough time earning its cost of capital on new projects. In terms of valuation, we value the company around $15 or $20 a share. We do that. Our primary methods there are discounted cash flow as well as sum of the parts. I think a lot of people rely upon the dividend and the dividend growth rate that the company is guided to as valuation metrics. In all our work, we really discourage people from thinking and valuing companies based on their dividends. On slide 2, the first chart here. So SemGroup has significant exposure to the DJ Basin, which is in northern Colorado, both through its ownership of 51% of the White Cliffs pipeline, as well as also they have some terminals, some storage, some trucking and marketing operations. So the DJ Basin is an important basin for the company. What's really happened to the DJ over the last 3 or 4 years is that there's been new pipeline entrants. And so for 2014, 2015, White Cliffs was really the only pipeline out of that basin. In the 2013 through 16 period, there was major investment made in new pipelines, competing pipes that we think are not only going to compete with SemGroup's White Cliffs pipeline, but also some of their other businesses like the marketing business, the terminals business. That's negatively going to impact cash flow, particularly when White Cliffs contracts roll off in the middle of 2019. White Cliffs has the first contracts to roll off in that basin, and we see significant excess capacity, pipeline excess capacity in that basin. Even if production grows strongly from here, we still think there's, something like 400,000 to 500,000 barrels a day of excess pipeline capacity. So what that means is we expect going forward lower volumes and lower prices on what we would consider to be SemGroup's best asset, White Cliffs. Turning to slide 3 here, SemGroup has exposure to the crude storage market. Both in its crude storage segment, which is primarily crude oil storage in Cushing, Oklahoma, but also in its marketing group. It does make some marketing margin from the storage of crude oil as well. And what we've seen is a flattening of the forward crude curve, which disincentivizes storage, makes storage less profitable for traders, and so we think that could negatively impact SemGroup's crude oil storage rates and also their asset utilization. Now, we've already seen this impact their supply and logistics segment. The crude storage segment has been holding up pretty well, mainly due to longer dated contracts, but going forward, we think this could be an issue for the company as well. On slide 4, another point on the marketing business. So SemGroup has its segments called supply and logistics. Basically what it is a marketing group. It makes its profits primarily from buying and selling crude and blending crude. So really what drives the profitability of this segment is regional price differentials, contango backwardation, so the shape of the forward curve, and also margins it can make from blending crude oil. You know, it'll take a Canadian barrel, mix it with 10 DJ barrels and try to make a spread, sell that barrel at WTI spec and make a spread there. So what we've seen is with the decline, sort of the rollover in crude oil production in many of these plays, as well as excess pipeline capacity and excess commitments on pipelines, is that there's just been a real increase in competition for lease barrels. This is especially true in the DJ, in the local Kansas market, and these are all markets where SemGroup's marketing division has a lot of exposure. So we've seen a sharp decline in profitability already, and we expect this to continue. Just to put this in perspective, this marketing group for SemGroup was on a run rate earlier this year of generating around $40 million a year in annual EBITDA, annual cash flow. This business has gone to negative EBITDA margins, and we think that it will be likely, it's likely to break even or possibly even keep negative EBITDA throughout 2017. So this is a real headwind for the company relative to what was a strongly profitable group last year. Turning to the next slide, slide 5, another area of business where we think this company has some issues longer term is in the Mississippi Lime. In the Mississippi Lime, SemGroup has exposure there in their segment called SemGas. They also have exposure in crude transportation and marketing as well. So in the Mississippi Lime, SemGroup gathers and processes wet natural gas as well as crude oil. As you can see from the chart here, activity in the Mississippi Lime has slowed down materially since the peak in 2014. So there's maybe 1 or 2 rigs running on SemGroup's acreage today. That's primarily going to be 1 or 2 rigs from Chesapeake and mid-states. That's down from a high of 50 as recent as late 2014. I think volumes there will have a near-term benefit just from some producers completing some drilled but uncompleted wells in the first half of the year. But after that, we expect volume declines to continue. And so we expect that to negatively impact SemGas, but also their Glass Mountain crude oil pipeline, as well as their marketing division and some of their other crude transportation assets. So some of these negative factors, we're turning to slide 6 here, some of these negative factors, what the company really needs to do to fix this problem is invest more heavily in its asset base, sort of diversify away from the legacy assets. The company is going to spend $500 million this year and probably at least $300 million next year, and so it has a cash flow outspend of around $400 million in 2017, and it's going to be at least $200 million in 2018, given where the current dividend is. As a result, we expect the company's debt to go up materially, and we don't think that the company's EBITDA is really going to grow, because what's happening is it has all these legacy issues like the decline in profitability of the marketing business that we talked about in late 2017, 2018, 2019, tariffs coming down, and volumes coming off of White Cliffs is going to leave a hole. And so it's investing in new projects which are basically filling a hole left by cash flow declines on existing assets. So we think the company is soon going to have a leverage problem. Leverage right now is around 3.5 times trailing 12 months EBITDA. We think that goes close to 5 over the next 12 to 18 months. And that's well above the company's comfort level. So we think that's going to put some pressure on the guided distribution and distribution growth. We think management sees this. On the last conference call, the stock was, on the conference call last week, the stock was quite weak because management really sort of backed away from their long-term dividend guidance, said they're going to review their dividend policy. And we think that they see what we see coming down the pike, which is this cash flow outspend is really going to increase leverage quite materially, and that's going to be a problem for the company. Turning to the last slide here, just a quick slide on valuation. Again, our primary, what we like to use when we value businesses is discounted cash flow. Here's that forecast and what it spits out. We end up valuing the company, in this case, at $17 a share. So I think fair value for the business is probably somewhere between $15 and $20, which would be around 50% downside from the current price of 36. We don't show it here, but we do a sum of the parts valuation analysis, which yields a similar result. So there is material downside to what we would consider fair value. The company's leverage is increasing. It's going to put more pressure on the dividend. The asset quality, I think, is B to C level assets in terms of overall midstream exposure. And a lot of these growth projects that the company is investing in, it's the right decision. It has to do this, but really it's replacing cash flow holes left from legacy assets. So that's sort of the overall view of SemGroup. Hopefully that gives everyone a little bit of an idea of some of the work we do and some of the things we focus on and how we look at these companies. But that's just one of our ideas, and many more. With that, I guess take some questions.
Yeah, we got plenty of questions here, kind of a mix between company specific and process things. Maybe we start out with everybody's favorite question, I guess every analyst's favorite question.
Yeah.
I think we can answer is SEMG still a short? I think you just answered that. So the second part of the question is, where is it going to be in 12 months?
Yeah, 12 months, I mean, no crystal balls here, so sort of who knows. I mean, I think the next 12 months are going to be difficult for the company, and main reason for that is because the 12 months after that get more difficult. And so, like I said, this year we have leverage around 3.5 times. We fast forward 12 months from now, it's 5. And I think the company's dividend growth guidance is really going to be in question 12 months from now. So, look, I think it's one of our top shorts. So I think it's going to be lower 12 months from now. Yeah. But who knows? We'll see. There's a lot could happen between now and then.
Yeah. Sounds like these guys, I mean, from our vantage point, are stuck between a rock and a hard place. If you were sitting in the C-suite, what would you do to fix the business?
Yeah. So what I would do right away is issue equity. Mm-hmm. I don't think management really wants to do that. They did an equity raise around this time last year, maybe it was in the spring, and that took the street by surprise. But I would raise equity. I mean, anytime you have an overvalued currency and you have a leverage problem, I think the smart thing to do for your business is to issue equity. Longer term, I think this company should think about reducing its dividend. I mean, I have the same problem with this company that I do a lot of midstream companies. I think it's over dividending. Mm-hmm. I think it's paying out a multiple of its free cash flow. It's paying out a multiple of its earnings, and in my view, that's not sustainable. It's not sustainable for any of these capital-intensive businesses. So that's a really tough decision when your shareholders, rely so heavily upon your dividend and your dividend growth, and that's how they value the company. But longer term, to fix the company's balance sheet, to fix the company in terms of reinvesting organic cash flows, I really think that one, it's an equity raise, and two, they should think about reducing the dividend to a more normal level. Put it within free cash flow, put it within earnings. Mm-hmm. I think that's the responsible thing to do. Yeah,
that makes sense. I think it's an appropriate segue here for another question. This one's more process related. And it has to do with just your communication with management teams. How often are you communicating with them? How important is that to you as you formulate a thesis on any given idea?
Yeah, we don't communicate often with management teams. Whenever we come out with an idea, I like to talk to management at least once, at least reach out, because in many cases there are questions and the management team is the only one that have the answer. If you need clarification on a particular disclosure, or there's some little facet of an asset that you don't understand, you want to talk to management and get that answer, that can be really helpful. But in terms of how to think about valuation or how to think about their metrics that they want you to look at, I think in a lot of ways management can steer you in the wrong direction, and so that's part of our process is taking the numbers, taking the metrics that management and all the other analysts look at and looking at other ones, right? Especially if there's a large discrepancy between what the company's reporting as in their GAAP financials versus what they're putting in press releases and what everybody's looking at and how everybody's valuing the stock. So, management contact is not a big part of our process, but we do try to reach out before we come out with new ideas just to make sure we have all our facts right. If there's any unanswered questions, maybe they can clear them up. Sometimes they're not so willing to talk to us. Some are better than others, but overall, it's not a big part of the process.
Right. Yeah. No. Everybody has a story to tell. Right?
Yeah. Exactly.
And let the numbers speak for themselves. So let's switch gears to another name. One that probably a lot of people are familiar with is KMI. So stock's up 18%, I think, in the past year. Where do you stand on it today? What are your thoughts, kind of after earnings? And I know they had an analyst day a few weeks back.
Yeah. So Kinder Morgan, it's one we've covered for a few years now. We're basically neutral on it at this point. I still can't get around to it from valuation. I still think it's very expensive. But in terms of I don't think it's a really interesting short here. I just don't see what sort of causes that next leg down. I think they've taken a lot of medicine with their dividend cut. They're deleveraging. I have some issue with some of the way they're deleveraging. In my view, a lot of these joint ventures they're forming, they're just moving on balance sheet debt to off balance sheet debt, and I have some issues with how they calculate their leverage ratios. But I don't think it's a compelling short. It's a very consensus long right now. It's probably more of a consensus long than I've ever seen it. People are, see the risk reward. They think it's quite favorable, and a lot of people want to be long this stock into an announcement around their Trans Mountain expansion project, whether the company sells it or whether they, probably do a joint venture. And there's a lot of talk about Canadian pension funds putting up a big price on that asset. So. It feels a little crowded to me right now, just sentiment-wise, and I think it's expensive, so it's not that interesting to me right now. Where if we were to get back involved in the short side, it would be after a dividend increase. So we've seen that movie before, where the company increases the dividend to some, what's in some range of what they consider distributable cash flow, which we have. Take issue with, and then people value the stock by capitalizing the dividend. That could create an interesting opportunity on the short side, but at the current price of 21 or whatever it is today, I don't think it's that interesting.
Okay, fair enough. So we got, I'm going to test your global energy macro metal here.
Okay.
Since OPEC started implementing its production cut agreement in January, obviously the rig count is up. We even in the question, 73 new rigs. We don't have to reference our notes here.
Yep.
How does just kind of domestic activity and the uptick from the bottom here play into your view of the sector in general?
Yeah. I'd say, if you look at our shorts, the vast majority of them have very little, if any at all, exposure to the Permian Basin, the Scoop Stack. Those are really the two plays that have attracted the most rigs, the most incremental capital, particularly the Permian. The economics in the Permian today are phenomenal. And the Permian from a midstream perspective is a little bit difficult to play. There's not a ton of options. You basically have Plains and Western, maybe some smaller players there if you want kind of pure play Permian exposure. Again, from a valuation perspective, I just don't think those companies are that interesting.
Yep.
So it's a little bit difficult right now to find longs in the midstream space from my purview, because so much of the activity is going to really these two basins, and it's so consensus and so well understood that the stocks have already had really large moves. I mentioned in the Permian exposure also Targa Resources as well.
Yep.
But these stocks have had big moves already. I think people appreciate their exposure to the Permian, so it's a little bit tougher. So, what we've been focusing on the short side is companies without meaningful exposure to those basins that are growing rapidly.
Right.
And then the other thing is, sort of who knows what happens with the crude price, but I think just as quickly as these rigs came into these basins, if crude prices go down $10 or $15, they could go out pretty quickly as well.
Yeah.
But we'll see.
Yeah, no, everybody's got to play nice in the sandbox.
Yeah.
So we'll finish with one question. What's your favorite idea? Top idea right now? Top
idea has probably been it's short tallgrass energy, the LPTEP. Admittedly, it's been my favorite idea since May of last year. Clearly, it hasn't worked. It's sort of a longer-term thesis. Really things start playing out for that situation between 2018 and 2020, but it's so absurdly overpriced and has so much downside that it's still my favorite idea. And it's one of these situations where investors in the midstream space, in the infrastructure space, they tend to be, very myopic, right? They look at this year's numbers, maybe next year's numbers, and that's all they care about. The value of any business is the present value of a very long stream of cash flows.
Right.
And the 1 or 2 years is like a small percentage of the overall value of the business. So I think that creates great, real inefficiency, and so that's what we try to look for and take advantage of. And that's definitely the situation with Tallgrass. I think what we see is this company having cash flow issues, circa 2018, 2019, 2020, on its two core pipelines, Pony Express and Rockies Express. It also may have some debt to pay back on on Rockies Express. And again, we're using conservative assumptions in valuations, and we see 70 to 80% downside for the stock. So it's one of those ones, and that's sort of one of the hazards of short selling is you don't really know when these things are going to play out, but when it does, we expect it to in a big way. So that's still our favorite idea.
Awesome. All right. Well, we'll leave it with a 70 to 80% downside call. And everyone, thanks for joining us today for our energy sector spotlight. I believe you can join us here again at 2:30 next Tuesday, and Josh Steiner will walk through his views on housing. So thanks a lot, everybody.